World of Finance, Part 2, starring Jeremy Clavens, Gabrielle Smith, Tessa Monroe, Dina Rubinson, Malcolm Smith, Herschel Bliefeld, Brad Aldis, Leila Azrez, and Merritt Hicks.
Hi, I'm Gabrielle Smith. Welcome to the Standard Deviant's Wild and Wacky World of Finance, Part 2. Over the next few hours, we'll be teaching you even more about finance than we did in the Wild and Wacky World of Finance, Part 1. You'll be learning about portfolios, CAPM, the security market line, stock and bond valuation, and much, much more. And we're refreshingly low in calories.
And hey, remember that since we're on video, you can stop us at any time you like and rewind to see what the hell we're talking about. You can also fast forward to the nudie scenes or hit pause when you've fallen asleep.
Do not attempt to use this tape as a substitute for attending class. Ollie North tried that, and look at all the trouble he got into. And now, I got a truckload of FBI agents on my butt every time I leave the house. And he has a syndicated radio show. I mean, where's the freaking justice?
In Finance 2, we're going to make extensive use of the concepts we covered in Finance 1, especially the future and present value formulas. So if you don't have a good handle on the future and present value interest factors, interest rates, risk, and perpetuities, you need to go back to Finance 1 and learn all that stuff. Otherwise, you try and do this stuff here, and you'll be lost and probably annoyed. And we don't want you to be annoyed.
Sometimes we'll use company examples that were introduced in Part 1. If you don't recognize a company name, don't panic. It'll be okay. Part 1. Dealing with more than one stock.
So, we're about to dive in. In the last tape, we dealt with evaluating the risk and return of individual stocks. Now we're going to move on to doing the same thing for many stocks. Doesn't that sound yippee-skippy?
Section A. Portfolios.
Investors hold more than one security to provide a cushion of diversification. Diversification, or purchasing more than one stock, lowers the overall risk to an investor. Because a number of investments are grouped together, it matters less what happens to each investment individually, but rather what happens to the whole portfolio. When you diversify, you are investing in more than one stock to reduce your overall risk.
A good way of looking at it is not putting all of your eggs in one basket. A brick could fall on the basket, and then you wouldn't have any left.
It's common sense. If you have several investments, you would probably want a good combination of stable stocks with low risk and small but decent returns, and some very risky stocks which offer the possibility of a large return. The cushion of diversification allows the investor to take a chance on the risky investments. You got it?
If an investor only had a portfolio of one stock, then that investor would be concerned solely about the return on that single stock. In a portfolio of one, standard deviation and coefficient of variation would be appropriate measures of risk. However, since most investors diversify and add other assets or securities to their portfolio to reduce risk, the investor becomes concerned primarily with the return and risk of the portfolio as a whole. Every investment is analyzed for its effect on the risk and return of the portfolio of which it is a part.
So, instead of figuring out the expected rate of return for a single stock, we need to shift focus to the expected return on a portfolio of stocks, signified here by K hat small p. The expected return on a portfolio is equal to a weighted average of the expected returns on each stock in the portfolio. The weight is merely the portion of the total stock portfolio that each stock makes up.
So let's pretend that our portfolio consists of H2O Co., the water utility, Nuggets Inc., a urinal deodorizer company, and Porkers, a company which produces 15 different flavors of pork rinds.
Their latest flavor is watermelon pork rinds. Of our total $1,000 investment, we have $400 in H2O Co., which is 40% of our portfolio, and we have $300 in Nuggets, which equals 30%, And we have $300 in Porkers, which equals 30%. Together, all three stocks equal 100% of our portfolio. The expected rates of return for each company in order is H2O Co. 8%, Nuggets 10%, and Porkers 20%.
To figure out our expected portfolio return, we plug the numbers into the formula.
The expected return on a portfolio, or K hat small p, is equal to the weight of investment 1 times the rate of return for investment 1 plus the weight of investment 2 times the rate of return for investment 2 plus the weight of investment 3 times the rate of return for investment 3. H2O Co's 40% weight multiplied by 8% rate of return plus Nuggets 30% weight multiplied by 10% rate of return plus Porkers 30% weight multiplied by 20% rate of return equals 0.122 or 12.2%. The expected rate of return on the portfolio as a whole is 12.2%.
Investors need to diversify their portfolio because it reduces the risk of investing in a single stock. Portfolio risk looks at how stocks in a portfolio work together. What the investor wants to shoot for is a portfolio of stocks that complement each other by picking up the slack for any stock in the portfolio which is doing poorly. So when one stock is doing poorly, another stock is doing well. The more that two stocks move in opposite directions from one another, the better they are for diversifying your portfolio.
Favorable interaction between stocks is sometimes known as the portfolio effect. If the stocks in your portfolio are moving opposite each other, then you are reducing portfolio risk.
2 investors. 1 portfolio. Something's got to give.
The statistical measurement that shows how two components in a portfolio move together is called the correlation coefficient, or R. This is another very important concept to an investor. The correlation coefficient can range from positive 1.0 to a negative 1.0.
I like that variable. R.
Positive 1.0 means that two stocks are perfectly, positively correlated, or they always move together. Negative 1.0 means that stocks are perfectly, negatively correlated, or they are always moving opposite of one another.
Two stocks with a correlation coefficient of positive 1 would be bad complements to each other because no risk is being diversified away. They move with each other exactly, much like soldiers in lockstep. So the less correlation, the lower the correlation coefficient, and the greater the benefits to the investor. However, in the real world, no two stocks have a correlation coefficient of either positive 1 or negative 1. All fall in between, and most have positive correlation. Why? Because most stocks do poorly when the economy is bad and do well when the economy is good.
Thank you for calling 1-900-FINANCE. Please press. Thank you for selecting portfolios. Adding a stock to a portfolio generally means a reduced risk. Because no two stocks are perfectly positively correlated. The addition of a stock reduces the risk or standard deviation of the portfolio, even if the added stock is positively correlated to the other stocks in the portfolio.
The goal is to reduce risk by selecting a portfolio of stocks that have low correlation. So it is best not to invest all your money in stocks in one industry, because they are affected by the same things, so chances are that their stocks will move together.
The key to remember is that you want less correlation between stocks in your portfolio. For instance, putting all of your money into GM and Ford would not be wise.
It'd be wise if you ain't a commie by American. American. American.
Although they are not perfectly correlated, They tend to move together because influences in the automotive market affect GM and Ford stocks similarly.
Section B. CAPM.
We're now moving on to how to use some of the statistics and formulas we've learned. The Capital Asset Pricing Model, or CAPM. Two very smart guys named Harry Markowitz and William Sharp designed a modeling procedure for analyzing the association between risk and rates of return for an investor. This formula is called the Capital Asset Pricing Model, or CAPM. CAPM is a specific formula that allows you to determine what risks you'll take on investments while considering the investment's rates of return. It's a general framework based on the concept that most investors are risk-averse and expect to be rewarded for that risk. CAPM allows you to determine what rates of return you require for specific investments in order to have a financially sound portfolio. CAPM is a key concept in finance and one you will use frequently. This is why these smart guys won a Nobel Prize. I mean, you don't win a Nobel Prize for inventing a new kind of tuna melt.
Almost all stocks are positively correlated because all stocks follow broad-based market and economic trends. Even an extremely large portfolio has risks, but less than smaller portfolios. As you increase the stocks in your portfolio, you can get rid of more and more of the risk inherent in the individual companies themselves. But you cannot eliminate all risk, because the companies move together based on the market.
Even stocks in a portfolio as large as the New York Stock Exchange are affected by certain upturns and downturns in the economy. This type of risk, inherent to the market itself, is called market or systematic risk. Market risk affects everyone and is the result of major events in the world, like inflation, business cycles, monetary policy, or war.
If you have 5 stocks or less, you have a lot of risk. But if you buy a bunch of stocks, diversify, you can get rid of some risk. This kind of risk is called company-specific or unsystematic risk. This is risk based on a company's own potential problems or situations like strikes, management, or poor financial strategies. Company-specific risks can be diversified away because they can be offset by events at another company in which you own stock.
Remember, market risk is the risk that all companies have because of factors in the economy and the market. Company-specific risk is based on the company's own specific risk through operations. Since most company-specific risk can be diversified away, most investment models measure market risk and use that to help investors. The models also assume investors are risk-averse, and so the models attempt to determine how to get the most return for a certain level of risk.
The tendency of a stock to move with the market is an important concept. We will now examine this closely and relate this back to the capital asset pricing model, the formula we will use to determine the appropriate rate of return for a stock based on its risk relative to movements in the entire market.
Section C. Beta.
A key element of CAPM is beta, also known as the beta coefficient.
Beta is a measure of the volatility of a stock in relation to some portfolio. In our case, it's a really big portfolio we call the market. When discussing beta, it is important to remember that we are talking about how a stock moves relative to the movements of the market.
Remember, at a certain point you cannot diversify your portfolio's risk away. So even a portfolio as large as the entire New York Stock Exchange still carries the market risk with it. Take a look at this graph.
This graph draws this concept for you. The yellow is company-specific risk, and the pink is market risk, the risk you can't get rid of. On the x-axis, you have an increasing number of stocks in the portfolio, and on the y-axis, you have increasing risk. We rated their risk by using their standard deviations. As you can see, when you increase the number of stocks, you gradually decrease the risk, because you are diversifying. Eventually, you get to this point when diversifying doesn't reduce the risk anymore. That's the same level as the market risk. See? You just can't get rid of that pesky market risk.
You cannot change the market risk. It's always there. The market fluctuates just like stocks do, The market as a whole moves up and down based on changes in the economy, or with a major impact like a war.
There's something that I would like to emphasize in case it is confusing you. When we estimate market risk, we use an estimate of the risk of the entire New York Stock Exchange. We can substitute a portfolio the size of the New York Stock Exchange for the market because the NYSE is composed of the largest, most actively traded stocks in the country from many different industries. Company-specific risk of any individual stock is diversified away to the point that the only risk we can find is equal to market risk. When you put all of the companies in the NYSE together, you eliminate company-specific risk to the point of the market average. This leftover risk is also called the undiversifiable risk. Makes sense, doesn't it?
The important thing is for you to understand the concept of beta. Although you could calculate beta, it'll normally be supplied for you in your class. To calculate beta, you need this big, huge computer and a bunch of programs, and it's just a real pain. And then there's a bunch of brokerage companies that publish beta, so why not get it from them? So I guess what I'm trying to say is, know how to use beta, but don't sweat calculating it.
Now that you know you won't have to calculate beta, let's talk about the values of beta, which you'll be given. The beta of the market is equal to 1. 1 exactly. If the individual stock you're looking at has a beta equal to 1, then it has the same exact amount of risk as the market. However, if a stock has a beta greater than 1, then that stock is more risky than the market. And if a stock has a beta of less than 1, then that stock is less risky because its risk is lower than the market.
Here you see a listing of betas for some of your favorite companies in the real world out there. As you can see, most betas range from 0.50 to 1.50, with the average being 1. Why is the average 1? Because the market beta, or average beta of the market, is 1.
Since the market beta is 1, a beta of 0.5 is a low-risk stock. Our earlier example of a water company, H2O Co., has a beta of 0.6. It is a public utility, and it has little risk. In all states of the economy, people need water. Therefore, the H2O Co. stock does not fluctuate as much as the market as a whole. This is where beta comes in handy. Beta is a true measure of a stock's risk, rather than the standard deviation, because it is measuring the stock against the market risk. Standard deviation, if you remember, just gives you the measurement of your individual stock's risk. Since you have a portfolio, you don't care about individual risk because most of it has been diversified away. In essence, beta is a measurement of a stock's relevant risk because it gives the investor a specific measure of risk compared to the market.
Beta is also crucial because it tells you how much the risk of your portfolio increases with the addition of a new stock. If you have a portfolio of stocks equal to the market portfolio with a beta of 1, and you add to it a stock with a beta of 1.90, you are increasing the risk of your whole portfolio. However, if you add a beta with a portfolio of 0.6, like H2O Co., you are lowering the risk of your portfolio. With a portfolio of stocks, you can determine the beta of the portfolio by taking a weighted average of the betas of the stocks in the portfolio. Let's look back at the $1,000 portfolio we had before. The one that had H2O Co., Nuggets, and Porkers.
The investment in H2O Co. totals $400, or 40% of the portfolio. Nuggets totals $300, or 30% of the portfolio. And Porkers totals $300, or 30% of the portfolio. H2O Co. has a beta of 0.6, and let's say that Nuggets has a beta of 1.8, and Porkers has a beta of 2.2. To get the portfolio beta, you multiply each beta by its weight in the portfolio and add them up. 0.4, the weight of H2O Co., times 0.6, H2O Co.'s beta, plus 0.3, Nuggets' weight, times 1.8, Nuggets' beta, plus 0.3, Porkers' weight, times 2.2, Porkers' beta, compute, equals 0.24 plus 0.54 plus 0.66. Kerchunk, equals 1.44.
The portfolio beta is 1.44. And this portfolio is riskier than the market because every time the market moves 1 point, your portfolio moves 1.44. That's good if the market goes up, but really bad if the market goes down. As you can see, betas of particular securities dramatically affect the betas of a portfolio. Beta is an important measure of a stock's relevant risk as compared to the market risk. Therefore, intelligent investors use a stock's beta as a measure of a stock's risk relative to the market portfolio of stocks.
Now that we understand beta, we can get serious about CAPM, our model for establishing the appropriate return needed on a stock.
Section D. Putting CAPM to work for you.
Cap.
M.
CAPM.
We need to put CAPM to work for the investor.
What an odd statement that was.
We've seen that beta is the real measurement of risk that an investor needs to focus on, because it tells that investor what risk his investment has in comparison to the market risk. Now we need to tell investors what type of return they should expect for taking that risk.
The capital asset pricing model allows an investor to determine what return he or she should receive on an investment per level of beta or level of risk. This is also known as the required rate of return because it is the rate an investor will require to invest in that stock. To figure out the required rate of return on an investment using CAPM, you need several components: the beta of the stock, the risk-free rate in the market, which as we discussed earlier is the short-term interest rate of U.S. Treasury bills, and the expected return on the market. The average return of stocks in the market is measured by a major index like Standard & Poor's 500.
I'm just a peaceful little frog reading the Wall Street Journal. Oh, what a glorious day. Oh no, it's the staple guy! Ah!
The formula for CAPM is the required rate of return for an individual security, K sub S, is equal to the risk-free rate of return, K sub RF, plus the beta coefficient of the stock, times the expected market return, K sub M, minus the risk-free rate of return, K sub RF. Got it?
Now remember that the whole idea of CAPM is that most investors are risk averse. So, CAPM determines how much return a risk-averse investor requires for a certain amount of risk.
What you are doing is adjusting the expected return of an individual stock for the risk inherent in the market. If you remember, portfolios of stocks can only diversify away company-specific risk, not market risk. You cannot get rid of market risk, so you have to adjust for it. The difference between company and market risk is a risk which you want to be compensated for. Risk that is calculated by beta, the risk of that particular investment compared to the risk of the market as a whole. Confused? Here's the important part. The capital asset pricing model adjusts the rate of return based on how risky an individual stock is relative to the market.
This next part is kind of confusing, so prepare yourself.
The market's overall average risk, minus the risk-free rate, or the rate on a T-bond, is called the market risk premium. The market risk premium is the risk that the market, not your individual investment, requires above and beyond the securities that have no risk. The market risk premium, when multiplied by an individual stock's beta coefficient, gives the investor his or her particular risk premium on that particular investment. The risk premium is the percentage above and beyond the risk-free rate that the investor will require to invest.
So, if Joe Average is going to buy a specific stock, he wants a return over the risk-free rate of at least the size of the risk premium.
The final step of CAPM is to add the risk premium to the risk-free rate, or the T-bill rate. And that, my friend, gives you the required rate of return. Some professors use the T-bond for the risk-free rate, so keep your eyes open.
Please tell me this is important.
Of course it is. I'll use an example to demonstrate. Let's suppose that the current risk-free rate on a long-term Treasury security is 6%. The current average stock market return is 12%, and you are interested in investing in a company called Therapets.
This company is a national chain of pet psychiatrists. The beta for Therapets is 2.6. We got that number from an investment magazine. Because of this beta, we can tell that this company is much riskier than the market. But what return percentage should we require if we make this investment? Use the CAPM formula.
The required rate of return for Therapets is equal to the risk-free rate of return plus the beta coefficient of the stock times the market risk premium.
The rate you require is equal to the risk-free rate plus the beta times the market risk premium. Fill in the blanks. K sub S is equal to 6 plus 2.6 times 12 minus 6. 6 plus 2.6 times 6. 6 plus 15.6. 21.6. The required rate of return for Therapets is 21.6. So, because we're such frumpy, risk-averse investors, we would require a very large rate of return on this risky investment.
And that, ladies and gentlemen, is the CAPM formula. CAPM allows you to find the rate you require to make an initial stock investment. It doesn't mean you will be offered the proper or necessary rate, but it tells you what you would require in consideration of the investment. Because CAPM calculates the required rate of return, it's a very useful tool for financial managers.
I think the best course of action here would be to start you on some lithium. Would that be okay? Yeah.
Section E, the security market line.
The one thing left to discuss about CAPM is the security market line. The security market line, or SML, graphically depicts the capital asset pricing model. The SML graphs CAPM. Remember, the CAPM formula looks like this.
The required rate of return equals the risk-free rate plus beta times the market risk premium.
Uzvinite, eta mista security market line.
Net, это ми este kod pied beelje na concert Rolling Stones.
Cigarette.
With the security market line, we can graph Therapets, our earlier example, and you'll be able to visualize its required rate of return relative to other points on the SML. In our Therapets example, we said the average market return was 12% and that the risk-free rate on a long-term treasury security was 6%.
We first must begin to construct the security market line. Come on, I'll walk you through this.
As you see here, the required rate of return goes along the y-axis, or vertically, and beta goes on the x-axis, or horizontally. On the y-axis, we have rates of return going from 0% all the way to 25%. On the x-axis, we have beta starting at 0 and going all the way to 3.0, or 3 times the market beta. As we said, the risk-free rate is currently 6%. Find 6% on the y-axis and draw a point. At this point, we need to draw a horizontal line all the way across the graph. Why? Because everything below this line, in pink, constitutes the risk-free rate. Nothing will be plotted below this area because all securities have returns at least as great as the risk-free rate. So the y-intercept of the vertical line at 6% is the risk-free rate.
To develop our SML further, we need to plot the value of the expected return on the market. Remember, from our earlier discussions, that the market beta equals 1. Find 1 on the x-axis. In this example, the average market return is 12%. Find 12% on the y-axis. Draw a point where these two intersect.
The beta of Therapets was 2.6. Using the CAPM formula, we determined that the required rate of return for Therapets is 21.6. If we now plot this information on this graph, we can construct the security market line.
To plot Therapets on the graph, first, find its return of 21.6% on the y-axis, and find its beta of 2.6 on the x-axis. Draw a point where those two intersect.
Now you can begin to see a diagonal line forming. This is the security market line. To develop the line some more, let's plot another company's return on our graph.
How about naked trampolining?
No objections? Okay. Whew. Okay. Naked trampolining has a beta of 3.0. But to plot it on our graph, we need to determine its required rate of return. How do we do that? With the CAPM formula. Risk-free rate plus beta times the market risk premium. So, 6, the risk-free rate, plus 3.0, naked trampolining's beta, times 12, the market rate of return, minus 6, the risk-free rate. So, that's 6 plus 3 times 6, or 6 plus 18. The required rate of return on naked trampolining is 24%. Now plot this value on our security market line graph. Find where naked trampolining's beta of 3.0 and required return of 24 intersect. They intersect here.
Now you can see the security market line. It's this diagonal line which graphs the relationship of risk and return, with risk being represented by beta and return is the expected return. Once you have plotted enough securities on the graph to draw the security market line, you are able to use it to value securities by their beta alone. If you were given the beta for a particular security, you can move up to the SML and then move horizontally over to the y-axis to find out how much return you would want for the risk.
For instance, a security with a beta of 2 would have a required return of 18. Or a security with a beta of 1.5, like our Heavenly Tattoo, would have a return of 15.
As you can see from the work we have done, the security market line can be used to price securities graphically. The security market line is used to determine the expected return on an individual security based on a risk-free rate and a risk premium. It graphs CAPM.
Now let's see how changes in inflation affect the security market line and rates of return in the marketplace. Inflation will merely shift the line upward. It will not change the slope of the line. Why? Because inflation affects all parts of the SML equally. Inflation affects not only the rates of return on the investor's stocks, but on the market as a whole, including the risk-free rate. So, as prices rise, the whole line shifts upward.
Look at the example which we just graphed. If expected inflation increases by 2%, the risk-free rate increases by 2% to 8%, and the expected return of the market increases by 2% also, from 12 to 14. You can easily visualize the reason for an upward shift when you plug the new inflation numbers into the CAPM formula.
Using CAPM, you can see that before the inflation increase, a stock with a beta of 1.5, like our Heavenly Tattoo, had a return of 15%. After the 2% inflation increase, plug in the new numbers. The 6% risk-free rate is now 8, plus the beta of 1.5, times the expected market return of 14, minus the risk-free rate of 8. This equals 17%. So as you can see, because all parts of the equation are affected equally, the line merely shifts upward. Our Heavenly Tattoo has a beta of 1.5 and a return of 17.
You may be thinking, what would cause the line to get steeper or the slope to change?
The only way the slope changes is if investors in the market as a whole become more or less risk-averse and require greater or less return per unit of risk. As investors become more risk-averse, they will want more return per unit of risk. Therefore, the return on the market, or KM, increases while the risk-free rate, or KRF, stays the same. The risk-free rate does not change when there's more risk because it's the risk-free rate. Duh!
Let's give you an example. If the risk premium of the market increased 3%, from 6% to 9%, the required return on Therapets would increase. Let's look at our graph from before with the numbers from Therapets on it. As you can see, when the market return was 12%, Therapets had a return of 21.6%. However, when you increase the risk premium by 3, using the CAPM formula, you can see an increase in the rate of return to 29.4%. The interesting thing to point out is that the risk-free rate hasn't changed. Investors are becoming more risk-averse because they're demanding a higher return for the same amount of risk. See the new SML. The slope has now changed.
So, to sum up, the inflation will cause a shift in the security market line, while the change in the risk averseness of investors will change the slope of the security market line.
The capital asset pricing model allows investors to determine the required rate of return for a given security. This equation, K sub S, equals the risk-free rate plus beta times the market return minus the risk-free rate, can be depicted in the security market line. The security market line allows investors to graphically price securities. Inflation will cause an upward shift in the SML, but won't change the slope. Come swim with me. I am Mr. Fish.
Part 2. Stock and bond valuation. Or, shouldn't this have been in tape 1?
Yes, stock and bond valuation is a logical outgrowth of everything in part 1. But then again, had we put any more math in tape 1, it would have received an X rating. Ha!
A stock is a security that gives part ownership in a company and almost always includes a dividend. A bond is a loan to a company. The company pays the bondholder interest for a pre-agreed amount of time and then pays back the loan altogether.
Okay, so I know that I want to buy stocks and bonds, but how much should I pay for them?
Well, let's start with bonds. We figure the value of bonds much in the same way as someone figures any other investment. If we were going to buy a coal mine, we would want to know how much the mine itself is worth and how much money the mine would bring us over the future. Figuring bonds is almost identical.
Basically, the value of a bond is determined by looking at its coupon payments over time and the repayment of a principal, as well as the riskiness of the company or governmental unit issuing the bond. By doing this, we can figure out the present value of a bond, or its value today.
I'm getting kind of tired of you people running off without explaining things.
Yeah.
You're right. We do need to define some terms.
Section A, terms.
And here come the terms! Remember, since this video is made in America, we're going to talk about how things happen in America. We talk about American bonds. Woo-hoo! See these here boots? They're rattleskin, made in America. Woo-hoo!
Par value is the face value of a bond. It's the amount of money the business borrows and promises to repay at some specific date in the future. Typically, the par value is set at $1,000. Investors almost never pay par value to buy a bond. When we talk about discounts and premium bonds later, you'll understand why. The coupon payment is the interest in dollars that's paid each period by the company that issued the bond. Coupon payments usually occur every 6 months. The coupon interest rate is the annual rate of interest on a bond. You can calculate the coupon interest rate by dividing the coupon payment by the par value. The coupon interest rate is stated in the bond's indenture.
Dentures?
Indenture is a fancy way to say the written agreement the company makes to pay back the money with interest. The market interest rate is the rate being offered on new bonds today. The market rate changes every day. You can find the market rate in the business section of any paper, or your professor will just give it to you. The market rate is what you use for figuring out the PVIF and PVIFA for bonds. Finally, the maturity date is the specified date on which the par value of a bond must be repaid.
So remember, if we're going too fast...
Yes, I know I can rewind. What do you think I am, stupid?
Section B. Bond present value.
The process of finding bond present value is the process of finding the current price of the bond. You're finding out how much you should pay for a bond if you're buying right now.
The coupon payments are like an annuity because they're a steady stream of payments over a specific period. So, because the coupon payments are an annuity, we use the PVIFA to figure the coupon payment's present value. The par value, on the other hand, is just a lump of cash we get when the bond matures. So, we use the PVIF on the par value. Added together, they return the present value of the bond. So, bond present value, or BPV, equals the total coupon payment paid each period on a bond multiplied by the PVIFA plus the bond par value at maturity times the PVIF.
What is PVIF? That's, is that when you kiss your girlfriend on the street?
When you kiss your girlfriend on the street. I think so. Public veracity infection fractor thing.
PVIF. Private Vermont
Wow.
Institute of Families.
I think that might be the actual answer.
Remember, when looking at the present value charts, that the interest rate is the market interest rate, and the number of periods equals the number of periods until maturity of the bond. Now let's put our equation to work and look at an example.
Mandu Cook. Mandu Cook.
Mandu Cook!
Mandu Cook.
Let's say Joe Investor is selling a Mandu Cook bond. Mandu Cook is an unusual Thai restaurant and Mambo room. Their bond carries an 8% coupon rate, a $1,000 par value at a maturity in 10 years, and has annual coupon payments. That means for the next 10 years it will pay you $80 a year, because the coupon rate of 8% times the $1,000 par value gives you $80. Then, after 10 years, you get $1,000. Of course, before you rush out to buy the bond, you want to figure out what it's worth to you. First, you run out to the Wall Street Journal to get the market interest rate on a similar bond, which is 10%. Just plug the numbers into the bond valuation formulas we just discussed.
First, set up your equation. The present value of the bond, or BPV, equals the annual payment, or $80, times the PVIFA, plus the par value, or $1,000, times the PVIF. Now refer to your present value tables and plug in the needed figures. The PVIFA for 10 periods at 10% is 6.1446, and the PVIF for 10 periods at 10% is 0.3855. So the present value of our bond is equal to the $80 yearly payment times 6.1446 plus the $1,000 par value of the bond times 0.3855. This multiplies out to 491.57 plus 385.50, which equals 877.07. So we've determined that the present value of Mandu Cook's bond is approximately $877.07.
Hey! You want to buy a bond?
Now let's shake things up a little. Let's say 2 years of the bond's 10-year maturity have passed. There are 8 years left now until the bond reaches maturity. So how do you calculate the present value of the bond now?
You simply decrease the number of time periods from 10 to 8. Don't worry about those 2 periods you missed. You're not getting the money for those anyway. When you look up the PVIFA and PVIF values on your tables, you use 8 periods and the 10% market interest rate. Then you just finish out the equation the same way we did before.
Now we have the coupon payment, 80 times the PVIFA of 8 periods and 10%, which is 5.3349.
Plus the par value, 1,000, times the PVIF of 8 periods and 10%, which is 0.4665. Okay? 80 times 5.3349 plus 1,000 times 0.4665. Compute. So with a little less time to maturity, the bond is worth $893.29.
Just remember that on an outstanding security, you need to use the periods left until maturity as your number of periods.
Can you give me a recipe for blueberry muffins?
Blueberry muffins. Yeah, just go down a giant Lidl box, 3x5. Guys like me cook all the time for ourselves, you know.
This is a man after my own heart. I mean, this guy. You and I should party because I think that you, my friend, are like wild.
Section C, discount and premium bond.
Coupon rates of bonds are fixed, but market interest rates are not the most stable things. Market interest rates move up and down all the time, so when the market interest rates rise, the value of a bond decreases. Why? Because the coupon rate on a bond is fixed. So a person holding a bond at an old small interest rate receives less money from interest than someone who bought a new issue, higher interest bond today, because the new bond has the new higher interest rate.
Let's say that you have a bond with an 8% coupon rate, and a year after you invested in this bond, market interest rates go up to 10%. That means that someone who buys a new issue bond today will be getting 2% more interest than you. If this happened and you wanted to sell your lower coupon interest rate bond, you would have to sell it for a discount. This is what we call a discount bond. A discount bond is a bond that sells below its par value because the going rate of interest, or market interest rate, is greater than the bond's coupon rate.
To compute the size of discount on an existing bond when interest rates have gone up, merely subtract the coupon payment on a new bond from your coupon payment, and you come up with a negative number. Then, multiply that number by the PVIFA for the remaining time period of the bond and the new market rate, and you get the exact amount needed to discount your bond for sale.
Let's look at a brief example. You bought a $1,000 Manducook bond. There are 8 years left until maturity. When you bought the bond, it had an 8% coupon rate and an $80 coupon payment. Interest rates have since increased to 10%. If you bought the same bond in the market today, you would receive a $100 coupon payment. In order for you to sell your crummy low-interest bond today, you need to discount it in order to compete with the newer bonds on the market that have the 10% rate. How much should you discount your bond in order to sell it? Easy. We told you. Just plug in the numbers.
To compute the discount, we subtract the new coupon payment from the old coupon payment, then apply the PVIFA. Subtract 100, the coupon payment on a new bond, from 80, the coupon payment on your bond, and you get negative 20. Multiply this amount by the PVIFA for the new rate, 10%, and 8 time periods. And you know how to do that. Just look on your present value tables. So, then you multiply negative 20 times 5.3349 and get negative 106.70. $106.70 is the amount that you need to discount your bond by. So, you take the par value of your bond, which is $1,000, and subtract the discount, $106.70, and you get $893.30. You will need to sell your outstanding bond for $893.30 in order to compete in today's market. You'll notice this is the exact same number we got a couple minutes ago when we figured the present value of a bond after the interest rates have changed. You can use either method and you'll be right.
Of course, interest rates also go down frequently. If interest rates go down in the market, then new issue bonds have a lower coupon rate than yours. Since your coupon rate is higher than those on other bonds in the market, your bond is worth more than par value. Now, you may not want to sell your bond because you've got a pretty good deal going. But let's say that you need some cash. You want to make a little profit. You could charge more for your outstanding bond than its par value. This is called a premium bond. A premium bond is one that sells above its par value because the market rate is below the bond's coupon rate.
Can you explain premium bonds?
I would say it's probably the bonds that investment companies give to their best customers.
Best customers, okay, ladies and gentlemen. That's a great answer, I think. I think this is just wow, amazing. Pow, pow.
To calculate the premium amount you should add to a bond if interest rates have gone down, you use the same procedure we did for discounting, but you end up with a positive number. Subtract the coupon payment on a new bond from your coupon payment, and you come up with a positive number. Then multiply that by the PVIFA for the remaining time period of the bond at the new market interest rate, and you get the exact amount needed to add a premium to your bond for sale.
Obviously, changes in market interest rates affect bond value. Interest rates and bond prices have an inverse relationship. As one goes up, the other goes down. As interest rates go up, bond prices go down. As interest rates go down, bond prices go up. We just saw that happen when we discussed discount and premium bonds.
Another important term or concept you will hear finance people talk about all the time is yield.
The current yield on a bond is calculated by dividing the annual interest payment of a bond by the bond's current price. Finance Trek. The objective of its mission: to boldly explore financial concepts that many have been confused by before.
Captain Quirk, we're approaching a gigantic alien treasury bond.
Raise yields! How? Divide the annual interest payment by the current price! Red alert! Red alert!
Simple enough, but let's do an example. Looking in the paper, we find that a bond from Best Buy is selling for $925. The current payment is $85 per period. So let's divide that quick. 85 divided by 925 is 9.19%, which coincidentally is the current yield listed in the newspaper.
Please note, the standard deviants neither support nor condone the use of Best Buy. Furthermore, the standard deviants neither support nor condone the use of newspapers.
So the idea of the current yield is to let you know what kind of return you'd get on your investment, not on the par value. Look at that bond again. The par value is $1,000, and the coupon payment is $85. That means the coupon rate is 8.5%, but the yield is 9.19%. That's because you're only paying $925 for the bond. So your return is based on the $925 you pay, not the $1,000 par value of the bond. That's what makes yield so cool. It relates the bond to you, not some abstract concept. Go yield!
Warning, current yield becomes less accurate if you're dealing with bonds that have a really big discount or premium.
You will also hear people refer to the yield to maturity and the yield to call.
The yield to maturity, or YTM, is the rate of return earned on a bond if it is held to maturity. Yield to maturity gives you the total rate of return for the life of a bond. However, as we just discussed, the yield to maturity changes frequently due to changes in bond prices.
To calculate a bond's yield to maturity, you could solve the present value of a bond equation for the interest rate, I. You would have to plug in the bond's current value, the time periods, the coupon payments, and the maturity value, and through trial and error, substitute values in for I until you found one that works. Pretty tedious, huh? Of course, there is an easier way. Use a financial calculator. You would simply enter N, which is your time periods, PV, the bond's current price, and make sure it's negative. Remember, this is money you're paying out. Then enter PMT, the coupon payment, and FV, the par value of the bond at maturity. Now press the I key. The answer, the interest rate, will appear.
Here, let's try one. Let's say we have 12 years left on our $1,000 par value bond. It has a coupon payment of 90 smackers and is trading for $1,100. Let's stick those buggers into the calculator. 12 N 1,100 plus minus PV 90 PMT 1,000 FV. Compute I. The yield to maturity of this guy is 7.69%.
If you don't have a financial calculator, you can try to figure out the yield to maturity. We'll still be here when you give up after 3 years of trying. The sheer tediousness of it, you would realize, makes you beyond grumpy. Of course, on tests, you'll be asked to know how to do it. So maybe you should just get the calculator. And even professors say you should do it.
Yield to call, on the other hand, is the rate of return on a bond if it is called before it matures. That means whoever issued it is buying it back early. The business or organization that issued the bond can call it if it has placed call provisions in the terms of the bond's indenture. Now, why would a business call a bond?
Call!
Uh-oh.
There are several reasons, but the main one is if they have a long-term bond with a high interest rate and the market interest rate has dropped significantly.
Call!
A company could call the bonds in order to save money on interest payments over time. Yield to call is the rate that an investor would receive until his or her bond is called.
Calculate the yield to call on a callable bond is very tedious if you don't have a financial calculator. It is also a trial and error process where you need to set up your equation and substitute in values for the yield to call until you find one that fits. So, let's do it the easy way and use our financial calculator. No financial calculator? Jeez, get with a program.
Sir, target in sight.
Good. Let's drop those calculators. There's a lot of people down there in dire need of knowing the yield to call.
Ready.
Open bomb bay doors.
Sir, bomb bay doors open.
Let's pickle them.
Counts away.
So, with the calculator, you input N, the number of years until the company can call the bond, then PV, which is the current price of the bond. Now remember, it's negative because you're paying out for it. Then PMT, the coupon payment on the bond, and FV, the call price. Then press I, and you will get the yield to call.
There is a trick, however. To pay you off for their ability to call your bond, most companies include a premium over your bond par value. This is called the call premium. So, a 4% call premium would increase the par value of an ordinary bond to $1,040. 1,000 times 4% is 40. 1,000 plus 40 is 1,040, right? When you do calculations for yield to call, you need to include the call premium in the call price, or future value.
Okay, haul out your financial calculators. Let's do this sucker. We'll say this bond has 6 years until it can be called. It's trading for $1,200 today. The coupon payment is $80, and like above, the call premium is 4%, so the future par value of the bond is $1,040. So we enter the bond's current price, $1,200 plus minus. It's negative because we had to pay for it. Now hit PV. 80 is the coupon payment. Hit PMT. The number of periods until they can call the bond is 6, so that's little n. The par value of the bond plus the call premium is $1,040, so we enter that and press FV. Now we just tell the calculator to compute and press I. After a few seconds, that returns the yield to call of 4.69. So let's summarize. Bonds have a value based on the stream of payments from their coupon interest rate, or interest payments, and their par, or face value. As market interest rates change, so does the value of an outstanding bond. As interest rates go up, the value of a bond goes down, and vice versa. Bonds are also described by their yields. Current yield is equal to the annual coupon interest rate divided by the current price of the bond. Yield to maturity is the return on the bond from the current date until it matures. Finally, yield to call is calculated based on the repayment of par value by the company before the bond is mature.
Section D, stock valuation.
Before we start stocks, we're going to have to do a little review on some definitions. Let's make it a contest. What's the definition of a preferred stock? Hey you, with your hand up.
Preferred stock is a form of equity with a fixed dividend payment. It's like a cross between a bond and a common stock.
Good. You get a gold star. Now, what is a common stock? Hey, Pops, how about you?
Common stock is the condition of being born outside a noble family.
Wrong. A flogging for you. Common stock is literally a piece of ownership in a company, which also entitles the holder to dividends.
Oi! I think I broke my hip!
And so, we'll start with the easy stuff, the valuation of a preferred stock.
With most preferred stock, the investor receives dividends forever, as long as the investor owns the stock. The same dividend every single time. They'll be perpetually getting dividends. Always. Perpetually.
I feel like they're trying to tell me something.
Perpetually, perpetually, perpetually.
A preferred stock is like a perpetuity.
Finally, yes. The preferred stock can be figured just like a perpetuity. Remember that equation? It's the payment over the current market discount rate. You use a version of the same equation for preferred stock. Here, watch.
Just use the perpetuity equation and stick in the preferred stock dividend instead of the annuity payment, and then use the current market discount rate, like normal.
If you want to see the rate of return on a preferred stock, and you know its selling price and dividend, just use this different form of the preferred stock present value equation. In this equation, the rate of return, K sub P, equals the dividend, D, over the current selling price, PV. Neat, huh?
So that's it for preferred stock. Pretty easy, huh?
Boy, and how, yeah.
Now we'll move on to common stocks.
Common stock is part ownership in a company. The company can pay you dividends, but they don't have to. If the company makes a profit, they can pay out the dividends or retain the earnings to do stuff. If you were a bondholder, the company would simply owe you money, because it's debt. But they have to make interest payments every period. Just like you, a company has to make its loan payments.
But getting back to stocks, the company has the freedom to decide the amount of dividend paid to its common stockholders. Therefore, common stock is riskier than bonds or preferred stock. But, as I'm sure you figured before, greater risk means greater chance for bigger returns. The price of a stock is dependent on the market and the success of the company. At some point, an investor will sell his or her stock. When the stock is sold, if the price has gone up, the owner will make a capital gain. However, if the investor is forced to sell the stock at a lower price, they will experience a capital loss. So really, a stock is made up of two components: the value of its dividends and the expected increase in the stock's market value.
You might be thinking, hey, if I'm a stockholder, I want those dividends. Quit being stingy with the dough, you stupid company. The thing is, if they retain the earnings, you may not get more cash, but the value of the stock itself should rise, because the company retained those earnings to grow. For our purposes, a rise in stock price is just as good as a dividend.
Even with the volatility of the market, common stock valuation is still important. We need to know what to expect from a stock, and therefore what a fair price would be to pay for that stock. So let's start the valuation of common stock.
To determine the present value of a common stock, you need to use a version of the equation we use to determine the present value of a bond.
The main difference in valuing stock is that instead of using the fixed payment for bonds, or pay, you use the potential dividend for the stock, or D. Let's see what that looks like in the equation.
The current price of a common stock, denoted by P sub 0, is equal to the first dividend payment divided by 1 plus the discount rate, or the required rate of return, raised to the first power, plus the second dividend divided by 1 plus the rate of return raised to the second power, plus the third dividend divided by 1 plus the rate of return raised to the third power, and all the way to infinity. Infinity? Yeah. Companies are assumed to last forever, so dividends on their stock are assumed to do the same thing. Confusing? You betcha. But then again, that's because it's the hard way. It's much easier to use the constant growth model, which is sometimes called the Gordon growth model. We'll show you that soon.
Who's Gordon? Is that fishing guy?
Well, I don't know if he did any fishing, but this Gordon was the guy who figured out the constant growth equation. The constant growth equation uses present value and the dividend to help us determine a fair price for the stock.
New for 1997, the Gordon Growth Model. For those who want speed, comfort, and the ability to compute stock valuations accurately. The GG model comes loaded with AM/FM 6-CD stereo, power steering and door locks, and most importantly, the time one dividend over the rate of return minus the growth rate. The Gordon Growth Model, the new standard in luxury from Finance Motors.
The constant growth model is the price, P sub 0, equals the dividend in time 1, D sub 1, over the required rate of return, K sub S, minus the growth rate, G. Of course, we do need to know the time 1 dividend, because all we have now is the current dividend. To get the time 1 dividend, or the expected dividend payment, we set it equal to the current dividend multiplied by 1 plus the growth rate.
Example?
Example?
Pizza Coli is an exciting new franchise that delivers hot pizza to you and a debilitating illness to your enemies. After consulting your best research methods, you decide that Pizza Coli is going to do very well this year, and you're interested in investing in their stock.
Who is it?
Pizza Coli!
I didn't order from them. Did you bring me pizza or disease?
I cannot tell you that right now, ma'am.
So we need to use the Gordon growth model to decide how much to pay for Pizza Coli's stock.
Pizza Coli's last annual dividend was $2, and you expect the dividend to grow at a rate of 10%. That's your growth rate. You also expect a 14% rate of return for the stock. That means 14 is your K sub S, or rate of return.
Ugh, we don't have a time 1 dividend.
Relax. We're just about to do that. The stock's time 1 dividend is equal to the current dividend, D sub 0, multiplied by the quantity of 1 plus the growth rate G. So let's do that. 2, the current dividend times the quantity of 1 plus 0.10 equals $2.20.
Okay, so now we have the dividend for time 1, and we remember from before that the expected rate of return for this stock is 14%, and the growth rate is 10%. So, to find the current price of the stock, P sub 0, the Gordon growth model says to put the final dividend, D sub 1, over the rate of return, K sub S, minus the growth rate, G. So that's 2.2 over 0.14 minus 0.10. That reduces to 2.2 over 0.04, which equals 55.
Pizza Coli's stock is worth $55. In the paper, you see that it's trading at $54.
Ooh, let's buy it. With our savings, we can buy
3 shares.
Oh.
Now that you have the basics of stock valuation down, we have to make sure that you recognize an important concept. Stock prices and dividends have a sort of incestuous relationship. Every stock's value is a combination of its market price and its dividends. The expected or predicted value of a stock is dependent upon its dividends plus the future selling price of the stock. But the future selling price is also dependent upon the dividends. So both values are somewhat subjective in relation to the dividends. Kinda weird, huh? Okay, time to delve even deeper into the world of stocks. Pizza Coli's dividend grew regularly over time, so it's known as a constant growth stock. Constant growth means that the dividend increases at the same rate over time.
Growth stocks are much more valuable than non-growth. Yeah, that's the spirit I like.
So what about stocks that don't have a constant rate? Darr!
The other scenario for stock valuation is the differential or supernormal growth stock.
Companies usually go through growth cycles. They grow quickly early in their lifespans. Then they grow at a constant rate. And finally, towards the end of their life cycle, their growth is very slow. This kind of growth is called non-constant. Supernormal growth comes at the beginning, when the stock is growing quickly at an unsustainable rate.
You see, if the company kept growing really, really fast, pretty soon their revenues would consume the entire world.
This little company is just starting out, but by third quarter of next year it should be worth $1 million and burgeoning with employees.
Are these guys endangered in the wild?
Oh no! You want to kill it?
How do we figure out the present value of a company's supernormal stock?
The thing is, we don't have any equations that can determine the value of a stock when it's growing at really big or uneven rates. We can only use the constant growth formula. So what we have to do is predict when the stock will grow at a constant rate and figure out what its value would be then. Once we have that value, we can discount it back to today's prices, then add the present values of the dividends during the supernormal period,
And now we know a fair price to pay for the stock.
This is pretty tricky, so pay attention. Let's walk through it slowly. The formula for supernormal growth consists of 4 major steps. First, you need to figure out the value of the dividends during the supernormal period. Second, you use the constant growth formula, which we went over earlier, to determine the stock value at the end of the high growth period. The value of the stock at the end of the high growth period is the same as the stock's value at the beginning of the normal growth period, or time n. You use the constant growth formula and the stock's first dividend when it returns to normal growth for D sub n plus 1, and your required rate of return for K sub s. G is the constant growth rate, not the supernormal growth rate. Third, you discount the value of the stock to the present day prices using the PVIF, present value interest factor, based on how many years it took to get back to normal growth and the current market discount rate. In the fourth and final step, we discount the dividends from the supernormal periods and then add them to the present value of the stock we got in step 3.
So, let's go over all those steps again. First, find the present value of the dividends. Second, apply the constant growth formula. Third, use present value to discount the value you get from the normal growth formula. Fourth, discount the supernormal dividends and then add them to the present value of the normal growth stock.
Again, let's learn through an example using our hypothetical company. Let's amend
Pizza Coli!
When
Pizza Coli!
first comes into existence, its stock has a growth rate of 20% per year. Then things settled down after 2 years and moved more normally and sustainably at 7%. For an investor, we'll say that the required rate of return is 10%. The last dividend was $2. How do you figure out the present value or price of the stock?
I cannot tell you that right now, sir.
This is step 1. First, you need to establish the value of the dividends over the first 3 years. Why 3 instead of 2? Because you need the third year for the rest of the equation, or else the constant growth model doesn't have a dividend to play with. Remember, the third dividend is the first one that happens in the 7% normal growth rate, so we need that dividend to use in the normal growth formula in step 2. So, you begin with a $2 dividend in year 0. With 20% growth, the dividend in year 1 grows to $2.40. That's $2 plus another 20%, right? Again, with 20% growth, the dividend in year 2 is valued at $2.88.
Okay, now growth returns to normal, the first dividend of the normal period. Take the year 2 dividend and multiply it by 1 plus the normal growth rate. So that's 1.07 times 2.88, totaling a $3.08 dividend.
Now step 2. Stick that dividend into the constant growth formula, using the constant growth for G. So the price equals 3.08, the year 3 dividend, over 0.10, your required rate of return, minus 0.07, the growth rate. Compute! 102.67. This price is the value of the stock based on the dividend of period 3, or at the end of year 2.
Now we move on to step 3 and discount the value of the stock from the normal growth period. We use the PVIF we find at the intersection of 2 for the 2 years and 10% for the current discount rate. 102.67 times the PVIF for 10% and 2 periods is 102.67 times 0.8265, which equals 84.86. Let's go back and get those first couple dividends, discount them, and add them into the mix. This brings us to the final step, step 4. Now you must discount each dividend in the supernormal growth period by looking at your PVIF table for its PVIF based on that period that the dividend came and the required rate of return of 10%. Then you multiply each dividend by its corresponding PVIF. The dividend of year 1 is $2.40 times the PVIF of 10% and 1 period, or 0.9091. Compute that, it equals $2.18. The dividend of year 2 is $2.88 times the PVIF of 10% and 2 periods, or 0.8264. Compute that, it equals $2.38.
And finally, add these numbers to the present value of the constant growth to come up with the total present value of Pizza Coli's supernormal stock. The present value of dividend 1 plus the present value of dividend 2 plus the present value of the dividends during normal growth all equal $89.42. Don't add the dividend from year 0. That isn't ours. So we've determined that the total present value of the supernormal stock is $89.42.
And that is about all that you should need to know about bond and stock valuation. Some of it gets pretty hairy near the end, so just rewind if you want a refresher.
Okay, let's run through what we just learned. The present value of a bond is determined by adding the PVIFA of its coupon payments to the PVIF of the bond's final sale value. Remember, the PVIF is the present value interest factor, and the PVIFA is the present value interest factor of an annuity. You get those from the tables on the insert cards. Stocks, on the other hand, are easy as long as their dividends are growing at a constant rate. Then, you can just use the constant growth model. If the stocks have irregular or differential growth, then you have to figure the present value of individual dividends. And then, when it goes back to normal, you can use the constant growth model again. Stocks are nice.
Ladies and gentlemen, please attempt to stay calm. We have reached the end of the wild and wacky world of finance, Part 2.
You crazy kids, I'll tell ya. So we finished yet another installment of finance, and we still have all of the arms and legs we started with. Isn't that great? Let's reminisce about what we learned. We learned about portfolios, and CAPM, and beta, and the security market line, and then we learned about valuing bonds and stocks. Can you believe that's all stuffed into our skulls now?
No.
Well, it sure is, Missy. And guess what?
No.
Well, geez, somebody's a downy clowny. Never fear, the rest of you cheerful audience people, because there's still another installment of finance out there.
We call it the Wild and Wacky World of Finance, Part 3. Cost of capital, capital budgeting, and cookies. So look for that one in bookstores.
Thanks for watching, and look for more video